Hey, this is Liz, and you're listening to the SouthCack Syndicate Podcast.
Absolutely. So where do you see us going in the next 3 months, 3 years?
3 months is hard. 3 years is hard. I think for us, normally here at the lake, here in this August month, it can be slow. And then we see a push there at the end of the year of more closings. You get close to the end of the calendar year, the fiscal year, people make financial decisions either at the start or the beginning of the
tax
next year.
related or whatever.
Tax related.
Yeah.
I will say I came here from a meeting at our Realtor Association, our local one in Anderson, with Congressman Duncan. The question was asked, what are the rates going to do? Are they going to keep rising? And he was very, very firm. He's like, yeah, they'll just keep jacking them up because they're doing everything they can to slow out this inflation. Obviously, it's not slowing.
No, they'll keep raising it until they see the turn. Yeah.
For my client base, they can remember rates at 18%.
Mm-hmm.
So
That's
they're
right.
not intimidated by a 5 or even a 6. And they're usually, they're conventional buyers by choice. They could be cash buyers. They could be paying themselves their cash back in a refi after closing. They're not as deterred. It is for our in-town buyers, our standard single-family home, 30-year mortgage. Some of those people are priced out. I mean, you're talking about this time last year where the rates were to today. The average home in America, according to our chief economist at NAR, Lawrence Yoon, is $500 more a month.
Yeah,
that can mean the difference in home ownership for some families.
So I think what
we'll
I'm looking
start
at,
seeing a decrease or a decline in home buying, not because the price of the real estate is too high, but they can't make the payment work.
Yeah,
right.
And
with the new product, not as supply costs have not seemed to come down yet. Like they're seeing it in the supply a little bit start to level, and some of it coming down, but some of it's up. There's still so much flux in build supply costs that we're still not getting the new product nationally to meet that demand, and we're short a lot of housing.
What I'm starting to do because of everything that's going on is I'm waiting for the opportunities. It may take a while. Market's going to slow a little bit. Prices are going to come down. And then what I'll do is I'll take the risk of the higher interest rate initially in hopes that at some point they'll come down, I can refi, and then I got the property at a decent price type of deal.
A few of my last closings have been adjustable rate mortgages.
I don't know that I'd go to adjustable. I think I'd just eat the high rate.
Yeah.
Because that adjustable stuff's scary.
It is scary.
It's like, man, you could end up in the 70s again with 25% interest rate. You don't know.
It is a little frightening, but these are folks that they could probably pay their note off.
That's right.
They think there will be an opportunity to grab a lower rate, and if not, if they can't stomach it, they're
just going to play the game.
They're going to play the game and pay it off.
That's not a bad call if you can do that.
Yeah,
for sure.
You've got to be cash flush to do it.
Typically, adjustable rate's cheaper than a fixed rate anyway, right?
Right.
A point or two. What is it usually?
It just depends. It depends on the product. It depends on the provider.
So they can raise that X amount of points in a certain amount of time. Mm-hmm. And so they'll let you know, depending on the provider.
But I'm talking about just when you actually get the loan, they'll give you a flexible rate cheaper than a fixed rate.
To start, to grab your business. Sure.
Yeah.
But they can go up, and I don't know this, but they can go up like no more than 3 points in 14 months.
Yeah.
Or something like that. But at the end of your 30-year note, it can go up as high or not higher than 12.
Right.
Well, I think we'll